yeah, we'll be able to answer questions and we encourage you guys to talk, but while we're kind of going over the beginning part, it would probably be a good idea just to keep yourself muted. And we're not the slideshow today isn't very very long, but we do want to have some sort of semi-formal kind of presentation going on that would be fitting for a video. So yeah, this will be in a video, guys. So
absolutely.
Yeah, nothing crazy though. We post them all on YouTube, so there's
Cool. Well, Austin, we are recording. Ready to go. Am I starting or are you starting this one?
I believe you are.
I am. Cool. Yes. Cool. Okay, well, we can get started now. As always, guys, thank you for coming out in the middle of the day on your Saturday. We already know that you got a lot of stuff to do. We greatly appreciate your time, and we greatly appreciate your attention. So, let's get into this. So you guys can go do something tonight, right? If you're in EST. So, today, we're going to be talking about candlestick anatomy. And to begin this conversation, we should really go back to what candlesticks are. So, the real term is Japanese candlesticks, and they are the main form of charting that we utilize at OBR and what most people do use in the world in general. It is a type of price chart that shows the opening, the close, the high, and the low price points for each given period. And when we say each given period, we're referring to time frames. So as you guys know, there's 5-minute charts, there's 10-minute charts, there's daily charts. Whatever time frame chart you're looking at, each candlestick will represent one of those. So if you're on a daily chart, obviously, each candlestick is going to represent one day. So it was invented by Japanese rice merchants centuries ago and popularized amongst Western traders by a broker named Steve Nyssen in the 1990s. This is something that Austin did not know. Neither did I, actually, that they were invented by Japanese rice merchants. It's pretty interesting. I wonder how they came to that, but,
Yeah,
we're thankful they did.
Surprising me. Yeah, the history behind it. It was even a surprise to me that it got popularized in the 1990s, right? I thought people were, not everyone, but I thought that the use of candlesticks was used for much longer than that, or popularized earlier than that. So, this is a rather new thing when you look at the relative time that markets have been around, which is very interesting.
Right.
Yep.
Before candlesticks, people were using bar charts for the most.
Yep.
Yeah.
Yep.
And
And
obviously,
a lot of people still do. You see a lot of the older people.
For sure.
Yep.
For sure. I even use it sometimes.
Yep.
But as we just said, now it is the most popular form of charting in the world today.
Yes. And what makes these candlesticks so significant? Oh, yep. Yeah, we appreciate it if you could mute yourself.
But if there's a problem, we'd love to hear about it in live chat VC Mute.
Yeah, absolutely. Yeah, if you can't hear for some reason, if there's something wrong with the audio or visuals, please let us know. That would definitely be of help. But as Logan said, right, these candlesticks, these Japanese candlesticks have become very popular in the 90s. And this is the main form of charting that people use today, right? If you go on TradingView, if you go on Thinkorswim, Webull, any of the native platforms that you're going to be doing your technical analysis on, 90% of the time, or even 95% of the time, you're going to find yourself reading Japanese candlesticks, okay? And the main things that we're going to be observing in the candlestick is the high, the low, the open, and the close, okay? And you can see the visual to the right there. This is what kind of this is how you read them, right? You're reading the candlestick based off of these 4 things that show themselves in the candlestick, right? Candlesticks will be different depending on what time frame they represent and what time frame your chart is set to view. As Logan said, right, a 1-day chart, one candle is going to represent 1 day of time. On a 1-minute chart, one candle is going to represent 1 minute of time, right? So every tick on the candlestick is information that you can use as confluence for or against your trades, which is very, very important. So, these are the main points we're going to be looking at when observing the anatomy of a candlestick, right? Going back to the topic of the call that we're on, candlestick anatomy, right? So,
absolutely. So, we're going to cover 3 main kinds of candles. And all candles are unique. They all represent information that we can utilize and should be utilizing. We need to be familiar with why candles do what they do and what it really means to be effective chart readers, right? But there are some very familiar candlestick patterns we quote in our trading on a day-to-day basis. And if you understand these, you're going to have a grasp of all candlestick patterns. And those 3 patterns are the Doji candles, which usually signal indecision. I sometimes refer to them as indecision candles, engulfing candles, and hammer candles.
Yeah, so getting us started off here with what Logan said, the first one, the Doji candle, and this perhaps is one of my favorite because it just appears so often. It's very consistent, and it truly represents what's showing you, which is indecision in the market. And when this happens, when there is indecision in the market, it typically represents two ideas: the potential for a reversal in price, or a consolidation around support or resistance, which, if broken out, could obviously signal a powerful breakout to a specific direction. These two are equally as important. I would say that it's more common for a doji to represent a reversal in trend, right? Because what a doji is kind of representing is a battle between the bulls and the bears, and it's not necessarily clear who's going to win. So there's often an indecision in price, and from there you can see a very quick and swift reversal in price, which we're going to show examples of right now. Logan, if you can go to the perfect. Yeah, this is great.
Yeah.
Yep.
So this first one on the left, we have to talk about a little bit because it's not just the doji, which is giving us all of the information we need, but rather the doji followed by the really strong engulfing candlestick, which you can see, followed right by the doji. So the doji at this point is showing us that there is resistance at this level. Buyers are trying to get up there, but they're getting shot down, obviously, by sellers, and sellers technically did win the battle of that candle, but it's indecision because we had price move lower and higher, as you can see by the wicks on both sides, and come lower. So there's indecision in that candle. Again, confirming that resistance point. So what is then important is the break of that resistance by the next engulfing candle, which we are going to go over just after these examples. And then obviously, on the right side of your screen is a doji at the high, which yielded a reversal. As you can see, price immediately came lower right after that doji because buyers were coming up. As you can see, it was a very strong bullish impulse wave by all the green strong candles that were prior. Buyers and sellers are trying to battle at this level, like we said earlier. No conclusion came to it. But after that happened, sellers obviously gained control and moved us down very, very fast, as you can see.
Right. Yeah, absolutely. And that's typically when you're going to be using the doji candle in your favor when it comes to a trading strategy, right? Recognizing those reversals. Obviously, the consolidation patterns are going to be important, but those might be a little bit more difficult to read and to really execute and make profits and make a successful trade off of is by reading those consolidations and those breakouts. But reversals are very good for doji candles. Nonetheless, moving on to engulfing candles, okay? So the engulfing candle represents a significant change in trend, right? Because it can represent kind of two different ways of explaining it, right? These more or less mean the same thing, but you kind of have to think about them differently. And that being the end of a current trend or the beginning of a new trend, or in general, the reversal of price. So I know that we said that the doji candle can often mean a reversal in price, but technically, there's a bunch of different types of candlestick anatomies that can signal a reversal or continuation in price. They all kind of have something in common when it comes to that, but they just do it in different ways. So this candlestick anatomy typically displays strong market sentiment in a specific direction, whereas the doji candle obviously doesn't do that, right? So go ahead here to some examples of the engulfing candle. Yeah, so Logan, do we have multiple examples for the?
We have two.
We do. So do you want to cover this one? And I can
Yeah, we'll just keep with the tempo we're going with here.
Sweet.
Yeah, as you can see, can you guys see my cursor, by the way? Also, can you give me confirmation?
Yep.
Cool. So
your cursor.
As you can see, not incorporating price action because this talk's not about price action, but as you can see, we had a bounce off of this resistance fractal that we had here with this, this is a doji candle. This is definitely an indecision candle, followed by an engulfing candle. And just while we're looking at this, and the last example we looked at for dojis, we also saw it, a very common pattern that I find in my trading is the doji followed by an engulfing candle. I find that is I use it for a lot of confirmation in my trades, and it works very, very well. But yeah, here's obviously a very bearish engulfing candle. This candle body engulfs entirely the candle prior, even with a small gap higher. And that's a great example of a reversal that led into a continuation of trend to the downside.
Aggressive reversal, yeah. After that, it really went down hard. Yep. And what is that on? That's on. What was the equity?
That was GameStop.
GameStop. Yep. Okay, moving on. Yep. And then this is Google, Alphabet Inc. We can see here. This is just another example of an engulfing candle. Only this one is bullish, and you can see it's rather tiny here. But this is a great example of to when the trend really got kickstarted. You can see right where my box is. Where I note the bullish engulfing candle, you can see that little red candle followed by a very, very large white candlestick to the upside. This is in hand what really sparked that aggressive uptrend that you can see happened shortly after. This is very bullish. Obviously, the sellers or the buyers came in, they took over, and the sellers just did not have the power to maintain. And that this candlestick anatomy kind of told that story, right? And this could have been, you could have made a trade based off of this ideology alone, right? So it's some pretty powerful stuff with the engulfing candlestick.
Absolutely. So we're now going to go into the hammer candle. And this is actually something that I've been noticing a lot more recently than I did prior, just because I've been finding that it is a very, very strong confluence, which we will see in our examples. But the hammer candle typically represents an intense battle of price, which results in one distinct winner. And I want to highlight the word intense. So we're looking at hammer candles for the end of the current trend or the beginning of a new trend, and also continuation. We have examples for both. This candlestick anatomy typically displays extremely strong market sentiment in a given direction, whatever direction that candle prints, really.
Yeah, and we made sure to use the word extremely there because, you know, an engulfing candle can show strong market sentiment, but the hammer candles are really, really strong sentiment. And we can see this from a visual here. Logan, what is this on? Is this on the...
This is XRP.
XRP, great, yeah. You can see here that XRP was already in an uptrend, and it kind of ran into this small corrective wave, which is very normal in uptrends. But you can see that it found its bottom very, very clearly. Its bottom was clearly visualized by this bullish hammer candle, right? Though price action did go rather low, it got bought up very, very quickly by buyers, and the buyers just took over and kind of reignited that uptrend.
Right.
And, you know, the sellers really did not show any strength at these levels. And when this candle prints, you can get a good idea that maybe it's time for a reversal or that this level is going to be very, very strong support as there's a lot of buyers at that level.
Definitely.
So really good example here.
Definitely. And it's important to note that the beginning of the candle, you know, this is a 4-hour chart. So at least in the first hour, maybe the second hour, maybe even the third, sellers were in control of this candle. You know, we had this long wick represents that. Sellers brought us all the way down to the price that we were looking at around here, 76,240. And then it came right back up because Austin said buyers regained control, lots of buyers at this level and pushes higher.
Yep.
So here is two examples of hammer candles. So we're looking at a hammer candle right here, which was used for a reversal. And as you can see, it is a hammer candle because price did close below the open. So it is a bearish hammer candle here. And then this is an example for a continuation of trend right here. As you can see, long wick to the upside, buyers were in control, sellers regained control, push us all the way back down. Same situation for both of these.
Well, yeah, same situation. But
different uses. Different uses.
Right, exactly. The hammer candle, one of them was the actual reversal of price, whereas the other one assisted in the continuation, right? And those are the two ideas that we said that hammer candles can often represent, and this is just a great display of that. This is, I believe, on the, what is this, a one
week chart on Bitcoin.
1 week chart on Bitcoin, right? And this is during 2019, so pretty intense stuff. That was actually part of the COVID capitulation where the bearish hammer candle continuation belongs. We actually went pretty low down there, and then we got bought up after. And you can see the candlestick anatomy at our bottom for the COVID capitulation. We see how we got bought up very quickly. We'll go into candlestick strength here shortly, but nonetheless, very interesting visual to look at. So this is me. So as we said, determining candle strength, right? So candle closes will range in their strength. Generally, for bullish candles, more confident closes will be near the high of the wick, whereas bearish closes will be near the low of the wick. I don't know why the wick is underlined there, but ignore that. Every candle has a story. The three examples we just went over are just a taste of where candles prove to be more significant. In trading, you need to recognize every candle and its individual strength to form a full picture of the battle between buyers and sellers. Guys, that's why the candlestick anatomy is so important. You are getting the idea in a visual of what's happening in the market. Are the buyers or the sellers winning or losing at this very moment? Is there indecision? Is there decision? What is going on with the price? What is the market sentiment? That is what candle strength in the candlestick anatomy is going to show you. Right, that is ultimately what we're trying to find. Right?
Yes. And maybe I could provide some context because I highlighted the word wick.
Right, I was just going to say, why don't we have it highlighted twice? Right? We should have.
Right. I just had it underlined there because when we're referring to the wick, we're mainly referring to the price territory of the candle. So thank you, Austin, for that slide. As you can see, this slide, I'm just using the wick as price territory, right? So the white line we will refer to as price territory. And here is visualized the strength of bullish candle closes. The way that I'm always imagining this is I draw an imaginary line through the middle of the candle, and if we close above that, then it's a moderately strong candle close. If we close at the high of our wick or the price territory, that is the strongest candle close. And then if we close below the imaginary line in the middle, that is the weakest. If we have a close even lower than this, obviously it will be weaker. You know, even if this was a slightly bullish candle, that would be the weakest. But you get the idea. It's below that center line that we're looking at, and this is excluding hammer candles because that would obviously be the most bullish. But this is very similar.
And then this is obviously just vice versa. Same thing here, right? When the candle is completely full and completely red, right? There's not a lot of wick showing to the downside. The sellers are winning, right? Price action to the downside is strong. You can see in the middle here, it's still very relevant. The sellers are there, but they're not as strong. The buyers are there. There are some buyers here. If we go to smaller time frames, you were to look at this candle on smaller time frames, you'd be able to see that there are some green candles. We are seeing buyers being active in this area. And then you can see here at the final one, this is the weakest candle for the bears, right? Though it still is a bearish candle, it's still printing a red candle. The bears are weakening, and the buyers are coming in, and yeah, it's just showing a lot of this is more or less, though it's bearish, it is showing some bullish technicalities to it.
Definitely.
Right? Vice versa, completely opposite of what we just looked at.
Yeah, exactly. I mean, like the easiest way to look at this is thinking about it in terms of buyers and sellers. So when we got down here, sellers were in control. Buyers almost regained control, right? They pushed us all the way back up here, but not completely. You know, not pushing us into having a bullish candle.
Mm-hmm. Yep. And still with this one, you want to maintain what Logan said, right? That imaginary line through the middle, right? That's going to go a long way in helping to determine the strength of the candlestick.
Yeah, definitely. So here we go into some examples of that in real action, right? So as you can see around this white line, all candles are showing bullish momentum, regardless if they are bullish or bearish candles. The bearish candlesticks that we are presented are weak bearish candlesticks, and the bullish candles are engulfing or a reversal, which is obviously via a doji. So here is the doji. Here is a very weak bearish candle, a bullish candle, a bullish candle, bullish engulfing candle, right? Bullish hammer candle right here. All around that level.
Yeah, and this is maybe perhaps my favorite example out of all of them, because sometimes the candlesticks aren't going to really tell you much at all. And by them doing that, it's going to give you information in its own, right? So we can see that there was no serious direction in this market, right? The candlestick anatomy, yes, there were some short impulses up and down. Ultimately, the candlesticks represented what they showed in here, right? Which was a consolidation. We didn't really have any upward momentum. Obviously, we did have some jolts in price action towards the end, but you can see once we got out of that yellow box that we have highlighted as the consolidation, we started to really find some direction, and the buyers took over, right? The red candles were very weak, whereas the green candles were coming in, they were full, they weren't really showing a lot of sell pressure, and that in hand is kind of the strength that we needed to break us out of that consolidation. And you can see how strong the candlestick anatomy, right, for the bulls were once we started to have some confident moves to the upside here. Logan, you have any comments on this? This is
Nope, you covered everything. Yeah.
Great.
Cool. So here we're looking at a firm. Obviously, we have a hammer candle which bounces off of this lower support line in this downward trending channel, which then carries us up to this higher resistance line that we have at this level. But yeah, obviously, bullish hammer candle. Like we said, very, very bullish indication of trend. So beautiful
If you
example.
stay on that, right, if you go look at the previous, the last touch prior to that, you can see that it was a red candle, right, at the bottom support line. If you put your mouse, the most recent touch before that. Yes, right there. You can see that though it was a red candle, right, it was still showing that buyers were there
At this
and
level.
that there was a potential reason for us to see a bounce here just by looking at and observing candlestick anatomy, right? So, very, very good. Yep.
Yeah.
Yes, and then this is a great example of a Doji candle. I believe, what is this on? Is
XRP
this on
4 hour.
XRP 4 hour. Yeah, you can see here, this is a great example of a reversal pattern. As we said in the Doji, there's a lot of indecision in the market up at these levels, and this led to a very, very aggressive price reversal in the asset that is XRP. The buyers and the sellers couldn't really make up their mind here, and then inevitably you see the next candle that started printing, the bears took over, and we went down from there. Though let me assure you that the buyers did have a chance to reclaim here, right? Just because you see a doji candle does not always mean a reversal candle. There's actually a doji candle in the middle of this uptrend right here. You can see right there, right? And the buyers were able to maintain. They did not lose the battle. Right. So there was a possibility that we made a lower high there, and we go down from there. But in fact, the buyers were still there. The market sentiment was still strong, so we continued higher. But it was very possible for that to happen. Then we ran into another doji, and the buyers eventually succumbed to the power that bears, and we saw reversal.
Yes. Austin, could you talk for a little bit? I think you were just cutting out.
Quick question. Are you guys taking questions?
We will take questions at the end.
We will take second questions here momentarily.
Yeah.
I was cutting out. I was just talking. I don't know. What did
we heard you. It kind of sounded like you were cutting out, but you sound fine now.
Yeah.
Yeah.
I was just, yep.
Yeah, so
I was just saying that, that the reversal, we had the chance to get bought up here, but eventually the sellers succumbed to the buyers succumbed to the sellers, and the sellers ended up winning the battle.
Yeah, absolutely. And then this was another example of, the doji followed by the engulfing candle. This would have been a great entry to enter in short because you have that, this shows we are at resistance. Sellers are in control now. We got an engulfing candlestick. We always look for more confluences for our active trades, but if you were just trading off candlestick anatomy, you could have done this, and this would have been a fantastic trade.
Yeah. Really good trade.
So, now
we're ready for
we are ready for questions.
My time to shine. All right, can you go back to that slide?
Which slide would you like me to go back to?
The doji candle.
This one.
Okay, so say I took a call at some point in that big bullish momentum after the flag. And I saw that first doji candle. Is that a good signal to raise my stop right below the doji candle?
It would be after we get the engulfing candle.
Okay, so I would want to wait. That was exactly what I was looking for. So say at the tippity top, right? I see that doji candle. So I'm thinking of timing for raising my stop so I don't get cut out and then it keeps going bullish.
Right.
So should I wait for that big red engulfing candle and then set my stop below that when raising it, should I do it earlier?
Yeah, if we saw this red engulfing candle, you should be out of the trade because regardless of it, maybe one time you'll find an example where it goes higher. Majority of the time, if you see this happen, price is going to reverse. If you see this setup that we see here, statistically, that's just what happens. But in terms of what's up, Austin?
No, I continue.
Yeah. In terms of raising your stop, like I said, once we got this engulfing candle, I'd move it here. Once we saw that we made a higher low here, I probably would have moved it here, and then probably would have just gotten out of the trade when I saw this candle print.
Right, and remember, more oftentimes than not, you're not going to be solely relying on just the candlestick anatomy. That's one confluence in your toolbox of trades or of tools, right? So though you see a doji, you're going to be looking at all your other indicators for decision making, along with this. So it's never just going to be relied upon a doji or a hammer or an engulfing candlestick. It's going to be confluence that's added to your decision making, and that's why we're here to understand these things, right? To add more confluence, to understand how the markets move more. So maybe you won't be setting your stop loss right according to the candles, but you'll be able to observe that and be like, hey, this is something to consider.
Yeah.
Totally. Yep.
Appreciate it.
I have a question. I saw the chart. Let's say if I'm making an analyst when the market opens, and I know there are quite a big variables of candlesticks, and to simplify the way I'm seeing the chart, I prefer to look out for the longest candlesticks, which tells me that it's a big momentum. What's the best way to see? I mean, if it's an uptrend and if I see a long bearish candle, that it's a strong saying that, okay, it might be a reversal. But if it was in a downtrend and a big and a long candlestick without a shadow, that's also a confirmation that, okay, this downtrend it's confirmed and it's continuing its momentum. Which is the best, continuing the trend or trying to search the reversal?
The trend is your friend, my friend, right? And I'm sure people have told you that before, and I'm sure Logan would agree. More often than not, you're going to have a much higher percentage of success going along with the trend than trying to time the top or bottom or a reversal in an equity or an asset, right? And this is just kind of common knowledge throughout the world. I'm not saying that like you have to know it, but like a lot of really good traders, right? They're going to tell you that the trend is your friend. Don't try to time tops and bottoms. And I would say that the same thing kind of goes along with reading candlestick anatomy. Logan, do you have any opinions on that?
No, I completely agree. The trend is definitely your friend.
Yep.
I think I heard him mention something about trading right at market open. I just want to make sure that he doesn't do that like a lot and hear your opinions on it.
No, you can trade right at market open.
Okay.
There's nothing wrong with that.
Okay, I thought it was a little more volatile. Or
right, but some people love that volatility, right? And they do very well on it.
Yeah, some people's trading strategy revolves around trading the open.
Okay.
So while I understand why you said that, why you said don't do it all the time, because if you're not experienced, it's definitely not something you should be doing because it is more volatile. But if you do know what you're doing, I would say that it's a little bit more discretionary. Some days it makes more sense to trade the open than it does the others. Like yesterday, when we saw AMC up, whatever it was after hours, GameStop up 30%. That would be a great day to not trade right at the open, in my opinion, because there's a lot of things going on. You don't really know where the direction of trend is going to continue. And as we saw, price came right back down after that. So, but that was a great point that you made.
I usually tend to wait like 10 minutes after the market because I know there is a danger of volatility, a lot of volume, and I prefer to wait like 10 or 15 minutes to calm down the market so I can see where it's the direction that it's going. For example, the London session is like the best session, I think. Like, okay, it's opening, the New York session, it's closing, London, it's opening, and I'm waiting like 10 to 15 minutes, something like that.
Absolutely, man. It's whatever works for you, right? Everybody has their own different styles and ways of trading the market and strategizing against the market. So whatever works for you, right? Whatever works for you.
Okay, thanks. That's it.
Something I've noticed is that in the first like 10 to 15 minutes, even 30 minutes, I have yet to not see consolidation and a wedge forming. And I love to take advantage of the breakouts from those consolidations. And it really, we skip the morning volatility and then it consolidates and I like do some plays off of that. And it's really entertaining to see things go my way.
I bet.
Oh, yeah, it's very entertaining to see things go your way, of course.
Yeah, I mean, like that's a great example of finding patterns. And, we could have the conversation about whether a wedge is a candlestick pattern. I guess it could be argued, but it's more of a price pattern. But yeah, what you said, that's a great observation.
Logan and I were also looking, when we were prepping for this earlier today. There's like thousands of different, technically different types of candlestick patterns, right? You can start having these compound patterns where if you see an engulfing candlestick with something else, right, it'll have like a specific name. Logan, what was the name of it? Was like the homing.
The homing pigeon. We found a pattern called the homing pigeon.
Right, there's a variety of different candlestick patterns that you can go and observe, right? I'm sure a lot of you guys have heard of like the 3 white soldiers or like the three black crows.
Just wrap it in a toilet paper like you're supposed to anyway.
No,
I fixed that, no problem.
But yeah, there's a variety of different compound candlestick patterns that you can go research, and I encourage you to do so. The only reason why we didn't really include that stuff in here is because, right, we would be in here for many, many hours, so we wanted to cover the general candlestick anatomy that you were going to see on a day-to-day basis, and you could take that data and kind of compound it together on your own and use it as a kind of a platform to get started into understanding how all this stuff works.
Right.
Because the world is much deeper than what we just went over. Don't think that's like we are quite literally scratching the relative surface of how stuff behaves, but the general concepts and understandings were displayed here. So
definitely,
that's just wanted to make that clear.
Yeah. And, like I said earlier, I think if you have an overall understanding of determining candle strength, you can understand almost all of those patterns. It's just different sets of candles that are presented after one or another. But if you have an understanding of determining candle strength, you'll have a great time understanding all of that. And those 3 patterns that we went over are definitely the most prevalent that we use on a daily basis.
Yeah, those are that's the starting point of everything, right? Understanding those things.
But even like in our active trading, I'll be like, oh, there was an engulfing candlestick there. That's when I'm going to enter. Or there's a doji there. If you want to take an aggressive entry, you could get in on a little bit of a confirmation after that.
Right.
Yeah.
I know I was looking at Facebook the other day, and the daily candlestick was like, it was like 2 p.m., and I'm like, this is the biggest daily engulfing bullish candlestick I've ever seen. Lo and behold, at 3:30 comes around, and we see a big sell-off, and we're no longer engulfing, and it's just like, I'm looking for these opportunities. I'm like, oh, I wish Facebook would have closed that daily candle above there, because that would have been so much confluence for me to enter, you know what I mean? I was very excited. But yeah, it's really all about candle strength. All it is you're visualizing the battle between the buyers and the sellers, and you pick the winner. That's really all it is, right? You most of the time you're gonna go with the winner, right? And the hammer, the bullish hammer, right? It's like the buyers are winning. We're probably gonna reverse or continue upwards, right? There's a good chance of that happening. Doesn't always have to happen, but it looks like the buyers are winning this battle.
Yeah.
Right? And the strength is strong in that direction, and that's really the basis point for everything we just talked about.
For sure.
So
for sure. And I just threw in a Tesla screenshot about a really great example that we were using recently. Me and Austin saw this hammer, and we're like, we actually didn't get in, but funny enough, but we did identify this hammer.
So dumb.
And yeah, it was really dumb that we didn't get in.
But yeah, and you can see that there's actually 2 examples of a. And guys, we're referring to visuals in live chat VC mute. There's the voice chat right above.
The channel we are in.
Right there. And you can see, Logan, do you see the other bullish hammer right before that that we saw that actually initiated? I believe would be our B wave of our of this fractal correction, right? So it showed itself twice, and both times we followed up to the upside, which could have made for wonderful trades. So Tesla's a great example. Tesla is very systematic and behaves very, in my opinion, very predictively. But
yeah. Cool. Any other questions?
Can candlesticks work side by side with Hikanashi?
Absolutely. Hikanashi is an indicator, and candlesticks are a separate tool of identification. You can use any set of confluences you'd like in whatever way works best. So absolutely, you can definitely use the Hikanashi indicator with candlesticks.
Because I also see that I know when it's a downtrend or something, but sometimes the candlesticks, it's like kind of messy, and I'm trying to, I don't know, I feel like Hikanashi helps me identify if the trend, if it's a downtrend or an uptrend.
Oh, are you referring to a Hikanashi chart?
Hikanashi is, I think you misunderstood him, Logan. Hikanashi are the candles that will show
the chart type,
the overall trend. And I'm just going to show a picture of this in live chat VC mute. But yeah, Hikanashi candles are great, right? You're still getting that same candlestick anatomy. You're just getting a better idea of the general trend. Now, these might be they're going to cater more to a beginner investor, right? I personally don't use them because I actually want to see how every candle is behaving and how every candle is printing. But if you ever want to simplify things and clear the air and understand kind of the general trend, these are great to do. But it's obviously not going to show you the 100% truth, right? There will be red candles that you print, but it'll show on Hikanashi will show them as green, right? But it's yeah, so they're good. They're good for some people not. But yeah, I don't mind them.
Yeah, that was actually my fault. I thought you were referring to the indicator. The chart, yeah, different type of chart. So they would be used separately. You would not use candlesticks and Hikanashi together.
No, you could.
You could, but
because the candlesticks still behave the same, so you could observe candlestick strength. You're just not going to be
getting
as much data as you originally would want to.
Right.
But yeah, I know people who use Hikanashis and they do well with them.
Would they overlay a candlestick chart with a Hikanashi chart at the same time?
What's that?
Would you overlay a Hikanashi chart on top of a candlestick chart? I don't know how you.
No, they're the same thing. A Hikanashi chart is candlesticks. You can see I put a visual in live chat VC mute. All it's simply showing is it's changing the color of the candlesticks to represent the trend better. It's not actually changing the anatomy.
I'm curious what the math is behind that.
Yeah, I mean, you could just look up Hikanashi. It's an indicator that's already built into TradingView. Everyone can use it. You don't even need to download it or find it. You just go right up to your candlestick button, and that's one of the options. I've used Hikanashi's for a little bit. It's just it kind of just deprives you of actually knowing what's going on a little bit, slightly, right? But anybody else have any other questions?
Yeah, quick question. So are these candlesticks universal for every type of trading, or are there like markets that it doesn't apply to?
Everything.
So people are going to be subjective about that question, but in reality, I'm just going to tell you what I'm pretty confident. It's all the same, right? Every market, the candlesticks are completely right. Buyers and sellers are in every market, and they behave very similarly in more or less every market, right? If you see a very bearish hammer candle in any market, right? If that's visualized, most of the time it's going to assist in signaling a downtrend. Right. Because it's simply just showing that the sellers are taking over and the buyers are absent.
Right. It's just a representation of supply and
market
demand,
behavior.
Really,
yeah, exactly. Yep. So they're useful in every market.
Anything that you can chart.
Yep.
Oh, by the way, what's with the gaps? What can you tell us about the gaps? Because I saw like tremendously big gaps between I trade forex in general, and I saw like let's say at 1.5 thousand I see a gap of like 200 pips, like it's humongous.
Right. Gaps happen when the price will move sharply up or down with little to no like trading volume in between. Does that kind of make sense? That's what happens. And then oftentimes in the stock market, there's going to be gaps between, after hours and in the pre-market and whatnot. But you mentioned in Forex. Logan, do you have any thoughts on gaps in the Forex market?
Yeah, I'm curious as to what instrument you're trading on Forex, because mostly you're not going to get gaps unless you're trading exotic pairs. But if you were trading an exotic, that's literally just a mislabeling of price that is quickly adjusted for, because usually when there's a gap in the stock market, it's because the day changed, and overnight and pre-market, post-market prices changed. But for Forex, it's going to be just prices jumped in a very, very sudden manner, and then that's the new level the prices are trading at.
Yep. And there can be gaps in every market, right? In the middle of the day, there can be gaps in the stock market. Stuff can gap to the upside. It's just a very, very sharp and impulsive move without giving the market really, buyers and sellers really time to buy in that area. So it just kind of gaps up. Yeah. And you can avoid gaps altogether if you were to go chart on with a line chart, right? Then you would just completely avoid gaps.
You'd also avoid wicks. Show it.
You would also avoid wicks. You would also avoid everything we just talked about, right? So,
yes.
But yeah.
What's the longest time frame to use for all these three that you were talking about?
They apply to every time frame.
Yeah.
Every single one.
They'll just if you have a daily, the best example to put on it is if you have a 1 minute hammer candle, it's gonna show a change of trend on the 1 minute chart. But if you have a hammer candle on the daily chart, it's going to represent obviously a much longer time frame because it's a higher time frame. Does that make sense?
Might have lost you.
Oh, I was muted. Sorry. Thank you. I understand now.
Awesome.
Yeah, I had a more similar question too. Like, when you guys are actively trading, are you looking at all the time frames, or are there like specific time frames you stick to?
It often depends on what kind of trade you're making, right? If you're day trading, then I'm going to stick to lower time frames. If I'm swinging something, then I'm going to acknowledge higher time frames. But oftentimes, whenever I'm making a trade, I often will observe almost every time frame that I can get my hands on. You know what I mean? Whether that be the 1 minute, the 3 minute, the 5 minute, the 15 minute, the 30 minute, the hour, the 2 hour, the 4 hour, the 8 hour, the 1 day, right? All these, I typically will observe everything, but it's often depends on what kind of trade you're making. Logan, I don't know what you do, Logan. Like, will you?
No, what you just said is exactly what I do.
Right. Logan will observe everything as well, just to get a better understanding of where you're actually positioned in this market, right? Because, if you're making a day trade, it's often good to know where you are in the grand scheme of things.
Definitely.
Like, are we? Yeah.
We just talked about this the other day, top-down analysis.
Right.
Yeah, but I really liked what you said to begin with about how it depends on what trade you're taking entirely.
Mm-hmm. Like, if you're scalping, there's no reason to look at a 2-month chart.
Right.
completely irrelevant to your
Yeah,
situation.
maybe you
You're
look at
gonna
the
be in and
hour
out.
or the 4 hour, but
Right.
it wouldn't make a whole lot of sense to look at the 2 month chart. Yeah.
Right.
And what's the most fitting time frame to find the support and resistance for the day? Let's say I want to day trade, but I don't see where are the highest high, lowest low, but most importantly, the support and resistance.
Yeah, I'm going to look personally at the daily chart first and then go to a 1 hour chart. And the 1 hour is going to be where most of my analysis will be done. But the daily chart is going to give me a better idea, again, of where we are in the bigger picture.
Yeah, Logan's going to go top down. So he's going to start at the daily chart, maybe take a little peek at the 4 hour chart. He's going to go down to the 1 hour chart, do some serious analysis on there, because the 1 hour does give a really good picture of where you are when you're looking to make a trade like that.
Yeah,
he's going to
during the day.
continue lower. Maybe he's going to look at the 30-minute, maybe something obscure like the 45-minute. I do stuff like that. Then he'll look at the 15-minute. He'll, of course, view the 5-minute if he's making a day trade, and maybe he'll even take a peek at the 1 minute or the 3 minute. But he's really doing top down, right? He's starting at that larger time frame and going lower. Or you can do the opposite if you'd like. You can start lower and go higher. It's really whatever works for you. I hope that answered your question.
Yes, thank you.
Of course. These have been really good questions, by the way, guys. I mean,
Yeah.
really good. I'm sure people are getting value out of your questions just as much as they would anything else. So, I mean, if you have a question and you think it's like a stupid question, I really encourage you to ask it, because there's probably like 6 other people who are thinking the same thing as you and they just don't want to ask it. But yeah, I was always that guy where I was like, I always thought I had like in school, like in high school, I always thought I had like a stupid question. But in reality, it just wasn't stupid. It was like multiple people were also embarrassed to ask the same things. But it would have been net positive for everybody just to have asked the question and got the answer, So, but either way, I think we got through a lot today, which is good. What time is it? Do we have a time?
4:42.
Wow, this might be the quickest one.
Yeah, but I do.
Try to take my location.
Yeah. Alrighty. All right, I'm gonna give it one last call. Logan, give him the last call for questions.
Last call for questions. But Sawyer sent in some charts and said, "What do you think?" Okay, so your first chart. I mean, we'd have to go like probably one-on-one and talk about this. But your first and your your first and your third circle look good. I don't really know what you're highlighting. Is it the engulfing candle or the doji?
I think he's just highlighting
Both.
strength, relative strength.
Yeah, I mean, if you're highlighting relative
specific
strength,
directions.
yeah, then you would be correct. Everything you're looking at. I see a good hammer candle in your second, and a good engulfing candle and doji. I see a good doji as well in your third message. In your fourth one, I see 2 good dojis. 3 dojis and 2 engulfing candles that you highlighted.
I really like the first one that you sent, Sawyer. On the first visual you sent, there's a lot of examples of prevalent candlestick anatomy, even some that you did not circle that I'm noticing, which is very, very cool. So yeah, it's quite impressive how much information you can gather out of just the way that candlesticks form.
All of those look pretty good, though. I just went through all of them, and I would not say anything is highlighted incorrectly.
Nope.
I forgot about something, which it's a very good question. How can you mark fake moves, fake movements?
Like a fake out. Yeah. Well, fake outs are called fake. Fake outs are called fake outs for a reason. They often fake people out. Obviously, sometimes, right, Logan? So this is probably something we should have covered, which we didn't. Sometimes you're going to see stuff deviate from what the rules say, right? So you're going to see a bearish engulfing candle, and price will continue to go upwards, right? That will happen, and nothing's ever going to be perfect. Just like how sometimes when a support or resistance is broken, it doesn't always mean that trend has to be in there, right? Sometimes there's fake outs and it'll return back to the trend, right? And even though candlesticks were closed above the resistance or support level, closed above or below resistance or support, sometimes it'll just be a fake out and really just kind of trick the market. Logan, do you have any insight as to how to be prepared for stuff like that? How to avoid stuff, that may fake you out?
Yes, absolutely. Having many confluences on your side. That's why.
There it is.
Yeah, that's
there it is.
That's why we are never making trading decisions just off of candlestick anatomy. We're looking at other indicators as well. The best way to avoid fake outs is to have multiple confluences for every trading decision you make. And those confluences could be a lot of things. We've covered a lot of things in our other TA videos on our YouTube's videos that we covered on other biweekly live calls. So I would check those out. We cover a lot of different things, but this is just one additional confluence that you can use, and very, very good confluence, I would say. Austin, what do you think?
This entire thing that we just talked about, candlestick anatomy, again, is one tool in the toolbox and should not be used alone or independently. This should be paired with not only your manual technical analysis, but also your secondary indicators like your moving averages, your MACD, your relative strength index, your RSI, your stochastic. And when I say manual TA, right, the way in which you draw trend lines, the way that you apply Fibonacci levels, the way that you count waves, the way that you view the market, right? There should be a lot, and then you look at that open interest, like what's going on with the volume in the market, right? There should be many, many confluences that go along. So if a lot of things are pointing downwards, but you're seeing bullish engulfing candles, maybe it's not the best time to get in. Maybe you should not take that candlestick anatomy as face value, right? So it's one tool in the toolbox. That's how you avoid fake outs. And
sure.
Even then, though, even if you use everything together in tandem and everything agrees, is there still going to be fake outs that get you? Yes, there will be. There's nothing in the world that is a perfect trading system. Even computers, as good as computers are, humans have practically built quantum computing. There is not one computer, there's not one algorithm, there's not one person in the world that has 100% win rate, and that is for good reason. It's because markets are controlled by people, and people are unpredictable. So there will always be fake outs, and you will lose, right? It's just gonna happen. But we're trying our best to understand these markets and mitigate those losses as significantly as possible, as much as possible. So at the end of the day, you just have to use as many confluences as you can to try to avoid the fake outs, but they will happen. They will happen.
Yeah. Cool. So any last minute questions?
What SMA or EMA works best with inside day?
Okay. Well, so all you're going to be doing, Logan. Do you want to talk about this or
no? I want you to talk about this one.
So you're going to you want to find a period that works for you, right? And I encourage you to go look at the live calls that we talked about moving averages. We really, really go in depth with this. But I typically, I'm a big fan of the 20 period, the 50 period, or even the 100 period. But what matters is that the time frame. So on a daily, if I'm day trading, then I'm going to be looking at the 20 period on the 5 minute, where each period represents 5 minutes of time. I'm going to be looking at the 50 period on the 5 minute, or the 50 period on the 15 minute. Right, so I'm using the same moving averages that I would normally use, just with different time frames attached to the periods. Does that make sense?
No. Inside day is is an inside bar on the daily chart, right? The candlestick pattern.
I thought when he was referring to inside day, just on inside the time of a daily time.
Oh, it's not intraday. Inside day is a candlestick pattern.
Well, then a candlestick pattern wouldn't really be used in tandem with a moving average, right? Because what if your candlestick is extended or below a moving average, right? Then it's not going to help you at all.
Oh, I just read in a book that saw that there was a strategy called inside day trading with 50 SMA trend.
Right, but that's not revolving around one candlestick.
No,
it's revolving around inside the time frame of that day. Right.
Yeah.
50 is very significant in the daily time frame, but it has nothing to do with one single candlestick in conjunction with a moving average. Just that doesn't exist.
Yeah, I know somebody else said that they had a question.
Yeah, I had a question. So I was talking to a trader, and he was telling me news is king. He was trying to make the case that even if the chart looks good, it doesn't matter because the CEO could get caught with fraud or just some random event. And I was really thinking about it, and I was kind of wondering, do you guys check the news, or do you agree with him to a certain extent? And if you do check the news, kind of what's your protocol for making sure that everything lines up, when you see the trade to taking the trade?
Yeah. Austin, do you mind if I answer this one?
Yeah, I was going to say you take that one over.
Yeah, your friend and I would probably hate each other. I'm always saying that technicals lead fundamentals, meaning that I think the technical analysis will always lead the fundamental news event. I always have been able to find in the past examples of, for example, I can spot a short entry before COVID happened because people behind the scenes were all like, some people were obviously speculating that was going to happen, moved prices in a certain way, which presented a sell signal. And that's why I, could obviously see a sell signal before COVID. And that's the same with almost every news event I've found. I do consider news as a confluence, just like dojis, just like engulfing candles, but they never fully drive my trading decisions. It's just one more confluence. Technicals mainly lead mine.
News will lie to you much more than technical analysis
Oh,
does.
yes. Oh, yeah. Price does not lie.
News will lie to you. It'll slap you right in the face. A great example of this is GameStop. GameStop goes ahead and launches their big NFT ordeal, but the next day they drop 3%. Well, according to a news analyst, GameStop should have went up. Why didn't it? Right? Because it couldn't get over a technical resistance barrier. Right? And there's sellers at that level. So if you know what I mean? And also the thing that you said about like a CEO like quitting or getting shot, getting killed or like whatever, like that's called a black swan event, right? And there's no way to ever predict how those things will happen in a market. And obviously that's front cover major news that is objective, right? It's not like speculation on something. It's like, okay, the president did this horrible thing, or Elon Musk retires and quits Tesla. Is Tesla's price action going to be positive in that? Probably not, right? But even before that happened, I bet you that there was technical indications that the price of the equity was going to drop anyways.
Definitely.
Right? So it's just technicals do really lead fundamentals, and we have data to backtest that, whereas the fundamentalists cannot say the same. So, I mean, go ahead and look at the S&P 500, right? It's been going straight up, but every day we come out with new news to be bearish. Why wouldn't you just be short on the market? The news is shit, right? Right. If you go look objectively speaking, right, our inflation is horrible. The interest rates are gonna, they're gonna mess around with rates soon. I mean, that's horrible news for the price of equities, right? The long term and the short term. But the technicals will tell you the true story and give you an objective look at how price action is actually behaving and how the market is actually behaving. So yeah, regardless of news, do what the market is doing, not what someone on CNN or whatever, or Fox or any news outlet. Just completely shut that out. In my opinion, though, you should still acknowledge news. Still acknowledge it. Just please don't make a trade based off of someone announcing a new NFT, because it's just not going to go well. Most of the time. If it does go well, then you got kind of lucky.
Yeah.
But I did want to clear... I did want to kind of touch back. We can conclude this now, but... Seventh, I do want to talk to you about that inside day thing, because I do think there's a misunderstanding with what we said earlier, and I just wanted to clear that up. You know what I mean, though, right? You can't attach a single candlestick to a moving average. It wouldn't make sense, right? Mm-hmm. When we say inside day, we mean the price action inside of that one day. There is, what you said though is true. There, people can view the term inside day as a, I suppose, a candlestick pattern. I'm not sure, but inside day is typically refers to the price action inside a given period. And you're right, the 50 period and the 20 period are very, very significant inside the daily time frame. So yes, but it's never associated. It's never associated with one single candle. Where kind of how we first discussed it, which is how I thought what you were saying.
No, inside it is a 2-bar pattern. Yeah, that's why I was reading and I saw that people were using it with the 50 SMA.
Right. So, but what if we have a 2-bar pattern very extended from the 50? How is that useful?
That's what I was asking. Yeah.
Right, because it doesn't work. It doesn't make sense inherently. I'd love for someone to display it, but yeah, I don't know too much about that.
Good.
Cool.
Maybe if you want to provide some information, definitely throw it in chat.
Yeah, please do.
Yeah. I'm sending you a picture right now.
Sweet.
Cool.
Let's go.
I do have to run, ladies and gentlemen. I have a birthday dinner that I must attend. But as always, we appreciate your time. We appreciate your attention. I hope everybody has a great rest of their Saturday. Hope you guys learned something.
You too. Have a good day.